Welcome back to the channel, guys. Super excited to have y'all here with us. In today's video, we want to talk about the importance of having a trading plan, what a trading plan should really look like. Some people try to make them way too in-depth and difficult, and they have like a whole pamphlet over their trading plan, which at the end of the day, there's nothing wrong, but we're all about keeping it simple. KISS, K-I-S-S. Keep it simple, stupid. Keep it stupid, simple. I'm gonna let you choose. But at the end of the day, guys, we like to keep things simple. A good trading plan consists of a few different factors. What I'm gonna do is I'm gonna be breaking them down for you today. And hopefully, once this video is done, you can kind of go and start building a rough draft of your own personal trading plan. And then from there, add to it, expand it, and grow. I'm not gonna really be on the charts too much for this specific one. I really just wanted to talk about what a trading plan really entails and some of the key things that I would say to factor in when it comes down to your trading plan. I'd say first and foremost, number one thing would probably be journaling. There's a number of different ways you can journal, whether you physical journal, notebook, pen, paper, whatever it is, whether you're using an automated service like MyFXBook, FX Blue, whatever it is, you know, TradeZilla, whatever. There's a number of these other trading journals, softwares, or things that you connect your broker to, whatever the case is. But the basis of a good trading plan includes a few key things. So number one, I would say would have to be your strategy, right? All the confluences you look for to take in the market. The thing is if you have a step-by-step guide in the sense of what it is that you're looking for in the market, like, hey, I'm only taking trades if I'm buying a discount or I'm selling a premium. Maybe that's a confluence you have. Maybe you want to be in a deep fib retracement. Maybe that's a confluence. Maybe you want to be trading with the trend only, buying higher lows or selling lower highs. Maybe you only take shift of momentum trades. Who knows? But once you have your strategy down packed to what it is that you like to take opportunities to, I would say the first thing would be having your checklist in your trading plan. Having your trading checklist, only taking trades if XYZ line up. The reason being is sometimes you can take a trade and break your own rules and you get lucky, but luck only goes so far. Eventually it runs out. If you take a trade and you take the trade with X and Y but no Z, you have a chance of winning or losing the trade no matter what. But if you win, it's because you're lucky. If you lose, it's because you broke your plan. In regards to it, if you're taking a trade and you follow X, Y, and Z, if you lose, at least you followed your plan. And at the end of the day, if you want to blame the market, you can blame the market. You're going to take losses no matter what. But if you're having a trading guideline or trading rules, you need to follow those rules. Me personally, I can't tell you what your rules should be. Everybody trades differently. You know, some of my rules, I kind of listed them out before, but you know, it's very basic. I'm trading with the trend. I want to buy deep retracements, sell deep retracements. I want to have nice continuation moves, or I'd like to take the first trade after a change of direction, but I like to let those trades kind of ride and swing. So figure out what your guidelines are per trade and checklist wise. And then, you know, to be honest, just literally just focus on that. And the second thing I would say when it comes down to developing your trading plan is your risk management guide. I remember when I first started trading, people used to tell me, oh, trade 0.01 per 1,000 in your account. I can tell you guys wholeheartedly that that is bullshit. That is super bullshit. And the reason why I can sit here and tell you guys that is bullshit is because risk management isn't based off of lot size. It's based off of calculations. I mean, lot size does have something to do with it, but lot size compared to your equity is not how it works. Like 0.01 per 100, no. You know, some of you guys can have very tight stops. Lot size could be higher. So at the end of the day, when it comes down to it, your risk management guideline should be percentage-based risk and then percentage-based risk to reward. Now, what does that mean? It means that if you're taking a trade, you're making some type of risk in the market. And if you're taking a risk in the market, what I would recommend is if you're willing to take a risk, you need to do a percentage-based risk. Don't say, oh, I'm risking 10 pips. Well, what does that 10 pips equal? Don't think of it as a dollar figure, think of it as percentages. You want to grow your account in percentages, right? So focus on percentages. So build a risk management plan based off of percentages. And a risk management plan could be, hey, I'm risking 1% of my account per trade. I mean, it's going to take you 100 bad trades to blow up. I mean, to keep it a stack, even if you suck ass, like blowing an account at 1% is crazy. I've never seen that. And you got to just factor in, hey, am I mentally stable enough to risk 2 or 3 or 4 or 5% per trade? I know people that risk 5% per trade. I know people that risk 10%, 15% per trade. At the end of the day, you have to look at yourself and your own situation, your own financial situation, and think about, hey, if I'm a little bit more risky, 100% I can make more money, but am I depending on this money? Am I emotionally attached to this money? You got to factor those things in. Number two, or that was number two. I would say number three, you need a trading routine. You need a routine of how you participate in the market, whether you call it your ritual or your guideline or whatever. You need some type of rules and routine when it comes down to the market. Now, what does that mean? It means maybe waking up 30 minutes, an hour before the market opens or whatever session you like to trade, and start preparing. Maybe it's, you get a coffee, you take a nootropic, maybe it's one of those things, but whatever your routine is, you need to have a disciplined routine. Hey, maybe you like to wake up and go to the gym and then trade. Maybe you like to wake up, trade gym. Maybe you like to do, it could be a number of different things, but whatever it is, routine-wise, you need to have a set routine and stick to it. If you're trading Mondays, Tuesdays, Wednesdays, and Thursdays, and you don't trade Fridays, then every day you show up with that same routine. Trading has to be, you have to kind of be mechanical with it and emotionless 100%, but like you got to have a very mechanical approach to how you approach the markets. So we already talked about your strategy, your confluences. We talked about risk management, we talked about journaling, we talked about risk management, we talked about confluences with your trading plan, and then we talked about your routine. I would say the last thing in regards to it is once you have a trading plan outlined, maybe print it off and laminate it, put it on your desk so you can see it. You as a human being, there's going to be a lot of emotions when you're trading. Maybe you miss a trade. You're like, dude, I called the move. I called it. And then you don't get in because you're too scared or you're chicken shit, whatever the fuck it might be. And the market's dropping and dropping and dropping. You get in late, you break your rules, and boom. If there's no pullback, if there's no entry, if there's no confluences, there shouldn't be an entry. So at the end of the day, the way I look at it is when it comes down to a trading plan, the plan just needs to be something simple in the sense of these are my confluences. These are the pairs that I like to trade. And then, the beautiful thing about journaling within your trading plan, guys, is eventually you're going to start seeing anomalies. And what do I mean by that? I mean, you're going to start seeing that, hey, every time I trade USD JPY, I lose. So if I'm losing every time I trade USD JPY, maybe I should stop trading USD JPY. Maybe every time you trade Euro GBP, on your long positions you win, but on your short positions you're always losing. Maybe only look for buys on Euro GBP and stop looking for shorts. Psychologically, sometimes you as a human being, the way your eyes, your brain is programmed, whether it's left hemisphere, right hemisphere, whatever it is, you may mentally only be able to see buying opportunities, while somebody else might only be able to see sells. Maybe trades that you see sells and other people see buys are completely different. But, psychologically, sometimes you got to factor those things in. You might be a better seller than you are a buyer. You might be a better buyer than you are a seller. Those are things that once you start, journaling, you can start developing your trading plan a little bit more. Maybe you realize that, hey, I suck ass at trading London session, or maybe you suck ass at trading New York session. It is what it is. I wish I lived in a time zone where it was more like Europe, because I could trade London session and New York session and still be able to live a life. London session here in the USA is like 2 a.m., 3 a.m., 12, depending on where you're at. So it's kind of hard to trade London. But New York session here in the USA, the range is from 5 a.m. to 7 to 8 or 6, 7, 8, whatever hours it is in regards to it, 8:30, 9:30, whatever it is, 9:30, 8:30, 6:30. But regardless, whatever session it is, what I want y'all to take away from what I'm talking about is you just need a guideline. Your trading plan is just a plan for you to follow. If you plan your trades and you trade your plan, you're going to have a good time. You're going to take losses, but the key thing is to develop a system, a mechanical system, and stay disciplined to that system. Trading is literally, simply put, it's all about discipline, guys. So within your trading plan, the biggest things I could tell you is to simply create a plan. It doesn't have to be the most thought out thing in the world. You don't have to say, hey, if the fib doesn't hit the trend line at this exact minute of the hour of the open of this candle, then I'm not taking it. You don't have to be that anal about it, but you just need to say, hey, these are the type of trades I want to look to take. Does this trade line up with my confluences? Yes. Is this trade in my timing zone? I like to trade New York session. It's in New York. Okay, yes. How much am I looking to risk? I want to risk 1.5%. Is that within my trading plan? Yes. How am I emotionally feeling right now? I'm feeling good, whatever. Cool. Yes. Sweet. Journal the trade before you take it. Journal the trade after you take it. How did you feel before? How did you feel after? What was the outcome? Cool. that lines up. Are all my confluences there? And timing's there? My risk management's there? If everything's there, then it's worth you clicking the button and taking the risk. But at the end of the day, you as a trader, you manage risk. You're a professional risk manager. I manage risk. So don't be afraid to click the button, create a trading plan, be disciplined with the plan. It doesn't have to be so crazy. I've seen people that have pages and pages and pages of trading plans. And, you know, I heard a saying once, and it's just like, some people, they spend too much time aiming. They're looking down the scope. They're aiming. They're waiting for the perfect shot. And by the time they find the perfect shot, the target's gone. They miss. Sometimes, instead of spending so much time aiming, it's better to just let some shots off. Just shoot. Because, shit, 7 times out of 10, maybe you'll hit something. But when it comes down to it, in the sense of the trading plan, what I'm getting to is have a trading plan, cover your bases, and then if opportunities align that follow the plan, take them. With that being said, guys, that was a quick video of developing a simple trading plan. Once again, you want to journal your trades. You want to write down your confluences. You want to write down your trading windows. You want to write down your risk management plan. And then at the end of each trade, you want to journal how you feel. And then start to analyze your own data. And as you're going to start seeing, that, hey, there's other pairs that I'm better at. There's other sessions that I'm better at. Follow the data and then see how it transpires. And that's some of the biggest things I can tell you guys when it comes down to developing a trading plan. Cool, guys. So once again, you have a full understanding of what it takes to have a simple yet effective trading plan. With that being said, guys, make sure you guys join the Discord. Make sure you join on our free community calls and get a taste of what it is that the premium chat is doing every single day. So with that being said, guys, appreciate y'all. See y'all in the next video. Peace.